Hi, this is Randy Finney with the Right Side of the Chart, and this is a mid-session update for Thursday, March 6, 2025. I figured I'd get one out, show you where we're at, levels to watch, I'll try to cover a few other things other than the market, but I'm going to start there, look at the markets, look at the market leading stocks, indexes. I want to do an update on the grains for you. I had a couple of requests on crude oil, even though I did get some charts out to you. There's not much more to add there. I'll try to get to that. And whatever else is relevant right now. When volatility spikes, that's when it's very conducive to trading. At least my style works very well in that because fundamentals are out the door. There was a couple posts on the site I saw recently. I agree. And I've said this, if you try to trade off the fundamentals, if you try to trade reacting to Trump's tweets or what the Wall Street Journal posts or the latest headlines on tariffs or God knows, or Ukraine or whatever else it is, you're going to be chasing your tail. You're going to be buying highs, buying rallies, figuring it's good news, only to see those rallies immediately faded. Then when the market drops on news, it's short, and then next thing you know, you're getting stopped out of those. Some bad news will be taken, but you can see. And I said this when Trump was elected. I said it before the elections. The market really, from my experience, I've been doing this a long time. They don't care who's in the White House, whether it's a Democrat or Republican. They really don't. Charts are the charts, what's going to be there, and usually nothing ever happens. What the markets do not like is uncertainty, and that's what we have now. And so I'm surprised they've been resilient as they have, holding. But again, it's the 200s technicals. That's what I'm trying to get to. The point I'm trying to make is trade the charts, the technicals, especially during periods of volatility. You cannot trade the headlines. You cannot anticipate the headlines in this environment. Trump is too, kind of a wild card anyway. So good luck trying to guess what his next tweet will be, and then everything else going on, besides DC. So, take a step back and just like I said, trade the technicals. That's what we're here for. All right. So let me talk about the 200s. I've been talking about the last few days. When we hit them day before yesterday on Monday, I told you I expected a reflexive bounce. We've already had that. I gave you some addition. We could, if they continue to hold it and rally, I gave you a max upside target. I think it's like 5.5%. But remember, off the lows, when we first hit it, the QQQ had just cut through them. SPY was coming up. I told you the SPY was a hair above. And we got it. That's a 3.325. That is a reflexive bounce. We're able to trade that then. And now it's looking like that may be it. That's where the arrows that day showed, a little up to about there and down. And, they had an opportunity to push up to those higher 5-minute targets today. This is where we were yesterday. We took out that trend line. We hit my first and second bounce targets, faded. We're back there. So look. As I often say, support is support, tone less broken. We're still on the 200s. 200s haven't gone, but I'm going to give you this video. We're not looking at just the 200-day on the QQQ. We're going to look at it, I am at least, and price support levels and trendline support levels, okay? The 200 days are great. A lot of traders look at them. Like I said, I've been saying that we're going to go down to them. I said that when we were at the highs recently, but I expected that this time around they're going to go. Of course, after, initial, you're going to, like I said, it's almost a guarantee they're going to buy the first drop, the first 10% correction straight down to them. If you've been dancing on them for 6 weeks, then you don't, then they could go anytime. So, the fact that we're back there again, and we already had that a decent bounce off there, 3.5% off the lows, maybe a little higher in the futures. That's probably it. If we close down solidly below today, then that's probably going to then flip that trend indicator at least to bearish and greatly increase the odds that we're going to go down to my longer term targets. Just I'll cover those in 1 second. So that's the short term charts right there, 5 minutes. Daily charts, QQQ on the 200s. But remember, the bigger picture was this. We've been in this trading range for months, this trading range here. Last time we got to the top, I said if we get up there, could see the potential for a marginal new high. It's a new high that I bet would fail. Predictable breakout. We had an ever so slightly marginal new high, which only extended the divergence. and so we'd probably go down to the bottom from there, and then ultimately break down, and we did, and pretty much in one fell swoop. And again, we hit the 200s right after we cut it, so that's why you watch different support levels. This was an important one, and we're still below it. So nothing has changed for months in my analysis that this trading range would resolve to the downside. Even if it got a break to the upside, that would fail. That the ultimate direction, next tradable trend for the market will be determined by which way this thing breaks. Although I dismissed an upside break, and as long as we still had the divergence, so it was pretty much this was or this. There wasn't a lot of which. Oh yeah, we're gonna go to. And look, you still cannot. Let me just say this: we're still on the 200s, guys. And again, support is support until it's broken, right? Can't dismiss a blow off top. If we happen to blow up in here and get back solidly in the range much beyond those bounce targets I gave you, about maybe 6-7%. Yeah, then there's a good shot though they could run it up there if they take back trend lines and all that. And the blow off scenario would be back on the table. Right now it's very low odds of a blow off top, meaning punch on through there and we get another 10-20% plus on the NASDAQ 100 and the indexes. So again, for me to say it's impossible, I'd be an idiot, and you shouldn't. You should run, not walk away from my analysis. Anybody that tells you the market can't or must do something, move on to the next person. Let me just give you that advice, and myself included. If I ever tell you we're absolutely not going to, market can't make new highs now because of blah, 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 or must go here, all we can do, again, I always talk in probabilities, not possibilities. Anything's possible. But now the probabilities are very low for that. And the probabilities, I pointed out several weeks ago, the weekly bearish engulfing candles on the major indexes, and said that that's a good chance that those would mark the end of the whole rally over the last couple of years. And the odds have increased and will increase further, especially this Friday, if we have a solid close. We put the 200s in the rearview mirror on a weekly closing basis. See, when you look at a daily, as I said, it's more than common to see an intraday pierce or a couple days. As I like to say, any break of support, whether it's this trading range, those trend lines, make a lot of terms up. One of them I have is the redder the better, meaning you get a big red fat candle down through there, especially end of the week. It's just going to sharply increase the odds that that's not going to be a whipsaw. Any intra-week break can still be a whipsaw. But now I think it's, that last hurrah is probably over, because we already got one and it went up, just dipped in. Just like I said before, when we hit it, they'd probably punch it into the trading range in order to blow out the most number of stops on short sellers, and also to suck in some bulls and longs to give you that fuel you need to get that next leg down. Because when you have a big leg like this, everybody, those that didn't want to short here because they were bullish because the market was all highs. We were in obviously the minority back then. I'm certain of that. I just had to turn on TV at the time, bubble TV. But then you get those, what I call JCL shorts, Johnny Come Lately shorts. They didn't want to short there. They didn't want to short there. But all of a sudden, last few days, they wanted to short. And so they needed to get cleared out a little bit to clear out that, excessive short interest. Why? Because the market, especially on the short side, can't make it easy. Everyone can't profit. You get too much short interest in a stock or an index or anything, then you have a lot of short sellers that are going to cover and take profits on any little drop. And you just need to clear them out. I much prefer shorting instruments with a relatively low short interest. All right, so that's it. Let's see where we go. Looks like today could be the day. This week, like I've been saying, it's probably imminent. And so SPY, I already told you the other day. The thing about SPY is we reversed a hair shy, as I pointed out, that day that QQQ was below. And so far, we're still, if you look at, turn off all of the other lines, still a hair above it. Right there, but for all intents and purposes, you're on the 200s. Let me do this. Let me go through. Here's what I wanted to do. We're going to look at the Mag 7 or 8 real quick. Give you an analysis there. Let's start out with the indexes. So if you want to kind of a feel for the market, yes, the S&P 500 is more diversified than the NASDAQ 100, but don't forget, I say this often, the S&P 500. The largest sector, there's 11 sectors total in there. The largest is technology by far. It's twice as large as the second one. This is it. This is tech. Tech is last time I checked, it was back in September 24th. 33% weighting and that is clearly broken down. So really, I don't want to say, I'm just going to say it. Almost nothing else matters. Healthcare, as big as it is, financials are big. Those are the next two, financials and then healthcare. But you can add up consumer staples, even industrials. This isn't the 60s or 50s or 70s anymore. We're not the U.S. we don't build a lot of stuff now. We force car makers like Toyota and all that. If you don't, 50% or more of the parts and the final assembly isn't here, we're going to tax the hell out of you on tariffs. So most of those cars are final assemblies here, but those are, when was last TV built in the U.S.? Zenith, decades ago. Tech is our thing, and so tech is everything. And again, we can debate that all day long, but mathematically, it's a third of the S&P 500 is responsible, attributed to technology due to the weighting, and over about half, really, essentially, in the Nasdaq 100. And you don't have to squint to see. My chart is as clear as day to me. This is a primary uptrend line right here. Very, very well defined off the October 2022 lows, comes in there on the January 2022 lows, comes in, catches that correction there that we covered and reversed on the morning of the August 5th lows. And also, what's beautiful about it, comes in perfectly with the 200-day simple and exponential moving averages. So those gave way a few weeks ago. Actually, that was Thursday, the 27th of February. And then this is just, I haven't modified this trend line. Then we back tested it right after. Then we back tested again. I always say the problem with back testing, shorting a back test, it's objective. I do it often, especially when you have dual. This is also, you had a price resistance there at 227. So it was an excellent opportunity. But what happens is when an uptrend line's back test, you can keep back testing every day you do, or throughout time, as time goes on, you're back testing higher and higher levels. So what I like to see to help confirm that breakdown will stick is an impulsive rejection, whether it's on the initial back test or weeks or months later, and that's what we got. So that's kind of pretty good. It's about as good as it gets, sell signal off on the tech sector. Yeah, and it's been dancing on my 217 price support for a while. You can see my other levels. This is kind of the lights out. That's why that's yellow there. This one, 192, is just when that goes, I'll probably be able to say with the highest degree of confidence we're going to hit my longest term targets, which again about 50% downside from the recent highs in the Nasdaq 100, 40 something odd percent on the S&P 500. So there, that's it. So tech is under the 200s and under the primary uptrend line. Let's just leave it at that. Financials. Here's where it gets a little sticky. I mean, not so much sticky, but where we could have even more than just a little bounce if these levels hold. This is financials. Again, I haven't updated these since I just moved a line I didn't mean to move. Trying to move this text since that's supposed to be 19.9 September. But this was the second largest sector in the S&P at only 12.5%, but still 12.5% is significant. And again, this is also the financials. If the banks break, the whole financial system breaks, right? So, financials encompass, the XLF encompass not just the banks, but also other companies, non-bank financials like Berkshire and insurance companies and things like that. But that's it. We're at the trend line, guys. That's it. And we're well above the 200s, but we're more important right now. The 200s are there. They're very important. If and when they go, you see I have a yellow line just above about 47, but this is the most important thing. That's a very clean, well-defined trend line. If you don't see it there, I'll draw it out for you here. Comes off the key October 2023 lows. You come in, you catch that key August 5th low, and so that's it. So where a lot of eyes might be watching tech right now, and tech is certainly, on a sell signal, it's broken down. The financials are at support as I speak, and it's really, they hit it there. They've been flirting on that trend line right now. So watch this level. A big red solid close through there is an additional check mark for the bearish case, and most likely means we're going to head lower. And again, to me, it's imminent. I just don't know, do they have it in them to give one last hurrah off this level or not? Imminent is relative to the time frame. This is a trend line that lasts over a year. So imminent doesn't mean 30 seconds from now, but it probably means today, to next week, somewhere in that time. That's what I'd say. All right, and then in there, what I like to do is you go to sector, look at the leaders, the big dogs. J.P. Morgan is by far the 800-pound gorilla in the room, the lead sled dog. There's no disputing that. King of the financials, king of the banks, and there's the primary uptrend line right here. You can see it's super well defined, clean, comes off that October 2023 low. You've got a lot of clean reactions on there. It's starting to crack right now, so that's no bueno for XLF. If JPM can't get above there, they're going to step in, sell JPM, which is then going to sell, bring down the rest of the financials. You can see Visa, all these guys put in divergent high. That's why the charts are pointing, whether it happens today, tomorrow, or months from now, they're headed a lot lower in my opinion. But a lot of them are at support, so they could have one little last hurrah here, or not. MasterCard, so I'm kind of just giving you an overview. Just broke support 553, 55, minor support. Put in that big divergent high there. Bank of America, done. See, this is what I think JP Morgan will look like not too long from now. Once that trend line goes, again, there's a beautiful trend line. This is, I believe, the second largest bank. Breakdown, textbook back test, textbook rejection, like I like to see. Hit the 200s, do not collect go straight to jail, and now down through there. So that is nothing but bearish. It's a big fat check mark for the financials. Berkshire, everyone knows Buffett's been loading up on cash, selling stocks, but I hate to form all ships are lifted with a rising tide, and all ships go down with a falling tide. So Berkshire will break that line. I don't care if they're not 100% in cash. They're gonna. And again, they're part of the curse of indexing. It works. It's a great thing to be a top component of an index in a bull trend, because inflows, pretty much, no matter what your company is doing, you're going to just benefit from the indexing. And likewise, when the outflows hit and everybody freaks out and says, oh, I got to get money out of my 401k, Trump's going crazy, and I don't know what's going on with Ukraine, and my 401k is down. It keeps dropping every day. I haven't seen that. People are accustomed. They're not used to that. And look, we're not that far off the highs. This isn't a major correction yet. I see one coming, but anyway, that's well. So just look at the levels, guys. I guess what I'm trying to say here, it's a game to me of check marks. More check marks you get on different sectors, key stocks. This is clearly a check mark. Wells Fargo, one of the biggest banks in the world and country, of course. Breakdown, back tested for 3 days below and rejected. So boom, boom, boom. Now broke this support. It's right on it right now, hair below it. American Express. Some of these, I guess, are trade ideas I shared in videos. S1 hit, T1, a little there, a little more to go. There's the 200-day moving averages. All right, I could go down the list, but what happens? I go down these by market cap weighting when I cover a sector, and so the further you get down, the less impact each one has. But there, you got a lot of financials. They've broken down. Again, they need just the lead sled dog. When they kill the general, this is the 5-star general, then they're dead. So right now we're trading a hair below. If they can save it by the close, that means you rally up to print the candlestick on back above, or at the end of the week. Sometimes you go down a couple days. Then you may get another hurrah off the 200-day moving averages on the S&P 500 and NASDAQ 100. If not, lower we go. All right. Let's see what else for you. I can go down the line. Healthcare is important, but not as much. It's the third largest sector, but it only makes up about 12%. Again, as of September, you can go Google search and see what the current weightings are every now and then. I'll update that. Looks like a bearish rising wedge pattern to me. We had a big divergent high here. It fell, 15%. Nothing goes down forever. Get oversold, you bounce, and there's where we're at now. So let's cover the mag 7 or 8. I mentioned this morning, you have some of these, quite a few have broken down, especially the weekly charts. I don't want it to be a super long video, but this is a simple, clean chart of Apple. One of my boards on the weekly, there was a minor trend line there. We got a sell signal on Apple, pointed out at the time. That was the top so far. Went down, broke this primary uptrend line off the 2024 lows there, back tested, and we're still below it. This is just a different board I have of it there. There's the breakdown. A daily chart right there. Most recently, there's that key. There's the breakdown back test of the first wedge, breakdown of the primary, a yellow uptrend line, perfect back test, rejection. And then most recently, I was highlighting this trend line to trigger the next sell signal. There was a stick save. You see the skinny part? That's called a shadow on the candle. The skinny part there. When it's down below, the shadow is a tail. When it's up atop, it's called a wick. And that means intraday only to see a stick say back above it. But then we broke yesterday and Apple's below that. So that's not so good. Microsoft, I talked about. Microsoft was hugging the 200 days forever and a day for months. Wouldn't give them up because the rest of the majority, only Tesla was sucking wind with it. But then once it saw other things breaking down, you had a final breakdown of below the 200s. Back test of the 200 exponential, the red line, and a rejection. So that's in a bearish technical posture, and sure, it can rally back up a little bit there, but we'll see if it does. And if it does, the 200s are resistance. Now, NVIDIA, my thoughts there. We're testing the recent lows. Remember, it's all about the market. That was our last short entry for NVIDIA, swing short entry there. So far, paying off very well. I have much more aggressive longer-term targets on NVIDIA, as you know. Amazon, divergent high, and this is what I talked about. These, even in the strongest of bull markets, you get far enough and long enough away from your 200s. At the very least, you got to come back and check them from time to time. So as I pointed out to you today, you can't put the knife in the coffin yet, but maybe soon. When you start to see 6 or 7 of the Mag 8, I call it Mag 8, 9, whatever you want to call it, and Mag 7 stocks below their 200s, then you can say, we're pretty much done. 200s are done. The market leaders are below their 200s here in a bear trend, short rallies back to resistance. And so that's it. So we've already had some like Microsoft and Tesla lose them. Others are now testing them the last few days, including the indexes, of course. It's not mere coincidence. But you have Alphabet, and Alphabet, this is bearish. Boom. Primary uptrend line. Very well defined. Look at that yellow uptrend line. 1, 2, 3, 4. And then the 200s. I'll turn off the line so you can see. This one back here, we broke them, but it was brief. And as I talked about, we hit too many stocks at support. We're long and bullish. So that I dismissed because that was an outlier, a one-off from the Mag 7. The rest were doing well. And so then you can see they bought diligently every pullback to the 200s, but this time it went, rallied back, and rejected, and we're below. Now, if it recovers them, that's net bullish. It's not going to change the entire outlook for the whole market. It'll change the near-term technical posture for this stock. You get enough of that, enough stocks recovering their 200s after either dipping below them or at least bouncing off them or recovering key trend lines, and that's going to be nothing but bullish. So what I always say, react to it. It's not my current expectation, but if it happens, you don't want to sit there short for too long if we start seeing all these levels recovered. Meta starting to crack this white trend line. I know this is a busy board, but this is the trend line I've been highlighting for months now. This one comes off that's the October of 2023 lows, have lots of clean reactions. And to me, trend line drawing, I always say, is an art, not a science, but the most important are recent reactions, and you have a lot of recent reactions there. Obviously, the more reactions you have, the better it is. Now, look, you got to almost squint to see it, but we are below. We broke down. We had a clear breakdown the other day, back test and rejection. And so if it takes out that's at Monday's low, Tuesday's low, that should be all she wrote. Broadcom, beautiful purple uptrend line, 200-day moving averages. I highlighted it back here when we hit them and there. And look at that. It's just been, again, this is just, to me, art. It's so well defined, and we're there right now. So we are at this point, I'm beating a dead horse, but as I said this morning, quite a few stocks have broken some key trend lines and or their 200 days, but a lot, including JP Morgan, the most important financial out there. A lot of these key, I put this one in the Mag 8, Broadcom, it's up there. Still testing the trend line in the 200 days. I mean, if you're thinking, Randy, that's below. Look, it's intraday. We're in close enough proximity, and there's the 200 simple, the blue line just below it. So again, I think all these will break. I think it could happen as early as today. If we rally, most I would say a few weeks, couple weeks, 2-3 week rally before you go back down. But that's not my preferred scenario. My preferred scenario is that these guys are going to break soon, especially because they faded. Today's rally had a chance to, and we're still back to where we were the other day. Tesla, look, again, I highlighted, gave you these, swing targets on this one a while back. We put in a big divergent high, broke down there. Tesla can't get any love lately. I know half the world hates it. It sucks like watching Trump's, speech the other night. And you have the Republicans on the left, the Democrats on the right, and they're booing and they won't stand up or cheer, and the Republicans are all giddy and happy. It's the country is that way too. You got half the country that hates Musk because he's Trump's minion right now, and then the other half that loves him. And so whatever. That's obviously net negative. But again, yes, is that net negative? Are fewer people going to buy Teslas because of it? Yeah. But on the flip side, the stock's down 45%. It's a good support. Also, that's not my final target. These targets, I created that way back here. That's still T4. This is still T5, and that's T6. To me, it's just a matter of, and we took out this trend line too, by the way. That trend line's been taken out. But there's price support there. That's why it's a zone, because you have a range, and we're at the bottom of that zone. So if that goes, we continue lower. What else for you? What else? Well, let me move on. Okay, you've got my thoughts on the market. I don't at this point, since the market had a chance, and we hit a couple of those early targets yesterday. Again, if we take this out, especially a solid close below their lows recently, QQQ will have taken out the 200-day moving averages. SPY is very close. If it goes down a few more percentage points, especially closes there. And XLF, the financials, and JP Morgan. Those are the big things I'd watch right now. The S&P 500, QQQ, all the Mag 8, JP Morgan, XLF. And again, and I keep speaking to active traders trying to get this stuff, but I always speak to, and I've done this a lot over the last year, I speak to the typical swing or trend trader that might be confused, head spinning. Wow, Randy, are we going to bounce? Are we going up, down? Short term, don't ignore 5-minute charts. They are irrelevant to a long term typical swing trader whose holding period is measured in weeks or months, especially a trend trader. We've had so many good sell signals in the last few weeks here. Let me reiterate. Started with those bearish engulfing candles and the divergent highs. Started with the failed breakout of the trading range as predicted with the divergent high, and then the reversal and drop down to, and then followed up by the break below the trading ranges. So everything that I've been seeing and expect is happening. So nothing has changed. So if you can, stomach the volatility and keep your eye on the prize, and I make, believe me, no promises. I will pivot faster than anybody can believe if I think I need to go the other way. So for long term, and I have long term accounts. Those are the ones I can't actively trade. I can't log in. I have various brokerage accounts, various family accounts. It would take me half an hour to log into every account and make orders. So those positions, I'm sitting tight, and I'm just waiting for additional evidence. Solid break below the 200 days, and I'll add into those. And if we bounce, then I'll also add on bounces. At this point, I'm confident enough that if we get another hurrah, unless it goes much above maybe the midpoint of the recent trading range, that'll be an objective short entry, as was the bounce the other day. And these are the longer term targets. Again, that'd be about a 50% drop in the NASDAQ 100. And just to reiterate, these are targets I've had for a while. We hit T1 and T2 here. We bounced off T2. T2 was simply a reflexive bounce off my second target to make a marginal new and still very much divergent high. And so my point being, they've already been hit. And so my expectations when the 200 goes, it's going to be a pretty quick swoon down, whether that happens this week, next week, or months from now. And therefore, depending on how the charts look at the time, I probably won't be looking to reverse or game any bounces there. We'll probably go down. And as I've said before, I think there's a decent chance we may even cut right through my third target, which is the next one to be, and go all the way down to T4 before we have a meaningful bounce, meaning where we can reverse and go long for a few weeks, not just a couple days or hours like I've been looking at lately. All right, let's move on. Let me cover, I want to just do the grains because they pulled back. Longer term, nothing has changed. So this is wheat. Let me go to the daily chart. Wheat has been putting in, been bouncing around this level. Big divergence, been building, building, building. And the only thing that's changed, we made an almost, yeah, we'll call it an equal low, still the same divergent low back there. And so we keep getting these little fits and bits. I've been highlighting here as a longer term, and I still maintain longer term bullish swing trade. We made just like the market, a marginal new low. This one requires patience. Doesn't pay you a dividend, but it's also a way to diversify. Just want to point out where we just recently tested, and this is the wheat ETN, WEAT. We recently tested that previous low. Off that low, we had a nice rally. It hit remember, these are my long-term targets on the daily chart. On the 60-minute chart, I've given you these targets here. T7 goes up there, and what we had here, there it is. So basically that rally came down, had a nice steep downtrend line, which has now been taken out, and that's it. So basically, buying a commodity at long-term support, a commodity that, unlike maybe SMCI or think Enron back, a couple decades ago, has a zero probability of declaring bankruptcy, of issuing stock dilution, new stock offering that's going to dilute the shares, has zero chance of corporate malfeasance. This is wheat. The day that we have a pandemic that wipes out half the world's population, then I might be bearish on wheat. World's population keeps growing, more mouths to feed, less arable land as they just continue to build. And so again, I'm saying longer term, when you can buy it down near multi-decade lows, here, then that's where, it takes, it might take some patience, but there it is. The charts are just as constructive as they were back here with this divergent high. And we had another, sell off of the latest rally that's just given us, just extended the divergence. And so I remain longer term bullish on wheat. And then remember, corn, I told you wheat kind of has been underperforming. Corn, here's my weekly chart. Let me go to the daily. Corn, remember I gave you this T1 was hit here. It was hit again right here, T1. And corn recently pulled back. I mentioned it in a video a week or so that we were coming up to support, and that was the support level there. And so far, a nice reversal off there. Obviously, we're going to need to take out this high. We've had several reactions there going back to early last year. That's the big level. So once we can punch above T1, it's with all my trades. As I list multiple targets, each one's a resistance level where I expect a reaction. And once that level is taken out, it increases the odds you're going to go up to the next target. So there's your story on wheat. But after this pullback here to support, it's objective, and it's still, now it's popped that level. It's still objective, in my opinion, for the next leg up. And then soybeans, and I do these together because they're the three big grains. There used to be one ETF that held them all. It was called JJG. Like many of these agricultural ETFs, it got retired by the issuer. So I'm going to put a new trend line here that I just noticed in doing this. And there it is. There's your magic line right there. You've got a nice trend line coming off the highs, a couple reactions to help validate it. T1's already been hit, so we popped that. I wouldn't be a seller at T1 even if I'm active trading. I'd hold out for it. I think we'd punch up to T2 and probably T3 there. And remember, these guys tend to move together. As I pointed out, corn and soybeans have been stronger. There's maybe a game of catch-up to be played. Usually when corn runs ahead of wheat, or vice versa, they'll kind of close that gap because they're kind of alternative food source grains. Like I said, you can go walk down the cereal aisle at your grocery store. You got cereals made out of wheat, some are made out of corn. You go to the Mexican restaurant, they ask you, do you want the corn or flour tortillas? Same thing, So if the price gets too high in one, I'm just saying it's not going to get. It's only like coal and crude oil. One will only go up so much because if the price of crude oil goes crazy, those plants that can still burn coal are just going to shift over, and they could shift their units to burning coal because it's cheaper, and so it's kind of closes that price differential there when they get away. Speaking of crude oil, okay, thank you. I had a couple folks yesterday inquired about it. Again, not a lot to add. Support, it's a little fuzzy. By fuzzy, I mean there were a couple reactions below there, and so as I mentioned in the post, that was support right there. I like it. I'm not in love with it. It could get you never buy solely on oversold, but as I did in that post I gave you, I circled the last 3 times we hit or were right at or a hair above the 30 level on the RSI. That's the blue line right there. And it was right here, here, and here. So this is, you ask yourself, did you want to be shorting crude there because everyone else was and they were bearish in there or there, or did you want to be buying it? Now, yeah, there's a lot of geopolitical risk right now, but you can't trade around that. You can't. This is the closest thing, in my opinion, that exists for a crystal ball to the stock market, to a commodity, to anything. And now, so I like to say, support is support until less broken. If it's broken, I don't have really good support all the way down here. So don't fall in love with it. As I said today, take it if you like it. It's not screaming good. I wish there were, wish we had some cleaner divergence on the shorter term charts. And I mentioned in that post, but I didn't give you this chart because I just wanted to get it out to you. You can buy it here down to about 68.50. Right there is the support level that I see on the 60-minute chart. And I gave you crude futures too. This is CL 120-minute chart, meaning every candlestick's 2-hour period goes back 6 months, and it's pretty well defined. So it's just trading one. Again, I would love to see strong divergence. I don't have any divergence here on the PPO. There's a little RSI divergence, but I'm passing along. First of all, it's first and foremost for request, and it's certainly worth taking a shot. Now, whatever, I could speak fundamental all day long. It's been dropping, maybe demand destruction, geopolitical risk, what's going on with drilling and OPEC and everything else. All right, let me move on. Take it, don't take it. There's the levels again. If we break, much below, and I give you potential bounce targets. If we can hold and rally off this support or go just a hair lower, which will be support on USO, right there, somewhere in there, those 2 bounce targets. And I'll wrap it up with, as I've been highlighting recently, last couple of weeks, the VIX was cheap. Highlighted this most recent divergent low on VIXY, and said that the VIX itself, which it has, would go up to the top of the trading range. But remember, I told you that the VIXY is not the VIX. And I say this because I get this question a lot from subscribers. Randy, the VIX is up 20% today, but my VXY or whichever is only up 10. You can't trade the VIX. You or I can. Nobody can buy it. It's a theoretical spot index. There's calculations, a methodology for it. You can look that up. But you can only buy futures on it, options on those futures, or ETNs or ETFs that track and trade those futures, such as this one. This one tracks the short-term VIX. So not the spot VIX, just the short-term futures on the VIX. Then you have midterm, you have ETFs that track the medium-term futures. So there's the differential. I'm going to get to in a second. However, I like futures myself, but I share that I know a lot of traders don't have futures accounts. So it's already up, it was up recently 31%. Break out of the trading range, more so on the spot VIX. I always say these are the longer term targets I gave you back here recently. This is that beautiful big old wedge on the daily chart, downtrend line, positive divergence, been building, breakout. S1 was already hit. Where did it go? Why does this say S2? I thought, S1 must have been the trend line taken out. And these are the longer term targets. And this is what the spot VIX looks like. So just keep an eye on the spot VIX, even if you're trading the futures or anything else. And so as predicted, a couple weeks ago when the market was at all-time highs, and this was at in the bottom of this trading range, that if we went down to the VIX would ultimately break out of this trading range, this purple box I gave you, if and when the market broke down below its comparable trading range. And that's what happened. So you can see the VIX has broken out because QQQ and SPY broke down below their trading ranges. The VIX is kind of holding here because people are buying, folks, man and machine, as I mentioned, are both buying the 200s. And they're going to buy the 200s till their 200s are gone, taken out. Then they're going to start selling stocks. So then you can see right now there's some negative divergence. So it's anybody's game right now, folks. There's a nice uptrend line if you want to keep a stop below there on your futures or ETF. There's negative divergence. However, negative divergence can get burned through. It's not a sell signal. It all depends on what the market does. That's it. So the market can turn around and mount a decent rally, 5-10% or more, We're probably going to break down. We'll remain in the trading range. It's not a, again, I still expect, just like I expect the markets break down, I think this will take off. And it could take off today. It's all, when does this do this? If and when the 200s go with conviction and there's a big follow through selling, and then the market drops another 10% plus, then the VIX should scream like it screamed back here. And we were long off at that point in time. And that was, I believe, the final target I gave you off that low there. But that's, on the spot VIX. Okay, guys, let me wrap it up here. You have the levels to watch. You know where we're at. At the end of the day, if you're not sure what to do, keep it light or paper trade, or just watch and wait for the market to make its move. We're at a key support levels, and they're going to either come in here and buy these levels, rally it up. Could be a few days, could even be a few weeks. I mean, there's positive divergence on a lot of 60-minute charts and a lot of those things that are falling to key trendline support and 200-day moving averages. So as I say, and it bears repeating, stay flexible, stay nimble, and just be careful, because market's going to move fast one way or another. It's not going to trade on the 200s forever. It usually doesn't do that for very long. It either rallies off them or it breaks down below them and then dumps. All right, I'm going to wrap it up here. This has been Randy Finney with the Right Side of the Chart. Have a great day.